Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Dave Keller. You are the chief strategist at Stock Charts, aren't you?
Yep, you got it.
That's a huge title. I love that title. So it's
I'll
you know
take
what
it.
it's cool. It's very respectable, and Stock Charts is a respectable company, and you are a
Yeah,
respectable analyst. I've always loved your work. I dig what you do, but it's been way too long. We
yeah,
last talked in November. It's been
yeah.
that long.
That's right. Yeah,
Yeah.
and a couple of things have changed in the last couple months. I would say,
Just a few,
understatement time.
just a few. That's an understatement. But going back to November, I
Yeah,
remember the last time we talked, you were very constructive on the markets. It was early November. You're like, I'm going to
yep,
see, I see us rallying into year end, and by golly, you were spot on, Dave. You really nailed it there. But soon as the calendar ticked over to January, the volatility kicked in, and things like you
yeah.
pointed out have changed. So how do you see the market now? Now that we got that rally out of the way, are we going to new highs, or is this a range bound market, or should we be selling rallies? What are your thoughts here?
Yeah, and I think it's a great question. I think it all depends on your time frame, Blake. I mean, I think there are a couple ways. If I'm a long-term investor and I'm trying to think of how 2022 is going to play out, I'm fairly confident we're going to finish higher than we are now. I think that's a reasonable expectation. But I think you have to remember, as an investor, the path between A to B is rarely a straight line. There's always sort of fits and starts. And I think, given the deterioration we've seen since we spoke last, right? Early November, things are sort of all chugging along, market making new highs, momentum strong. November, December, the market kept going higher, but the momentum starts to deteriorate. The breadth conditions start to deteriorate, and that continued into January. So the theory of sort of strong market into year end makes a lot of sense based on seasonal trends. That played out beautifully. But I think you also saw a lot of signals embedded in the market in November and December that told you at least to be wary of what January could become. And it's really played out in sort of that worst case scenario of all the negative momentum really follows through new year, and the market drops. And now we're sort of in this no man's land. We're sort of in this wilderness after the initial leg down. And the question is, which way's next?
Yeah, and I since you're a technician and you're CMT, which is very, very respectable in our industry as chart readers, I've been kind of looking at the setup just in the broad markets on the S&P, just because I use the S&P to gauge a lot of different things, from
Yeah.
currencies to metals to how I'm going to approach different asset classes. But just taking the broad market of the S&P, looks like we might be trying to carve out a head and shoulder type of pattern. Do you see something similar?
Yes, and if you think about what that implies, it implies some negative pattern, some negative movement here in the future, right? But
Sure.
but the key with a head and shoulders top, the key with a topping pattern, whether you think it's a big head and shoulders top or a basing pattern, meaning like a big run and then you're sort of consolidating, if you break through the lower end of support, it really implies a downside follow through. And it's not just on the S&P, like, I mean, I think it's on a lot of individual names as well, right? If you think about
Yeah.
what Meta platforms or Netflix or some of those that have gapped lower, there are a lot of stocks like industrials and others that are holding up still above support, but we're really close. We're one or two bad days away from those really breaking down as well. So that, I feel like at this point, if you think of the market in terms of probabilities, it's possible the S&P rips above 5,000 in the next 4 to 6 weeks. I think that's unlikely, but it's possible.
Sure.
It's possible the S&P drops another 1,000 points. Improbable, but possible. And it's somewhere in the middle. But I think you have to recognize that a big down move from here, the next leg lower, is definitely a possibility, if not a probability, given what we've seen. And that's why I think right now is about risk management more than anything else.
Well, that makes a lot of sense. I want to ask you one last question before we move on to maybe some charts that really have your eye. But
Yeah.
last year when we talked, you were talking a lot about the IWM, and the Russell 2000, I think, is a really great gauge of markets, of a market to watch, especially the underbelly, if you will, of the markets. We saw a rally and then a false breakout, and then the IWM, or the Russell 2000, broke down. And
Yep.
how much of an impact does that play into your decision making when you're looking at the broader markets?
There are a number of really good nuggets of investment wisdom embedded in your question. If you think about it, right, a lot of times I'm asked about small caps and what they mean. And I think if you look at the S&P 600 small cap index versus the Russell 2000, you're sort of looking at smaller companies versus smaller companies with a lot of other junky stuff embedded in there. And I get the same, I would make the same point about the NASDAQ, right? The NASDAQ is certainly a growth-oriented index, but there's a lot of kind of junky, crappy stuff on the lower end of quality, and the NASDAQ, it's pretty bad. And so it's not surprising when the market goes to more of a risk-off mentality, you're going to see both of those, the Russell 2000, the NASDAQ, struggle just because there are a lot of highly speculative things that even in a good market have a low probability of succeeding, right? And so this really starts to drag them down. I think on the IWM, on the Russell 2000, it's been an important chart because that was a really consistent base, right? While the S&P, the NASDAQ were rallying through much of last year, Russell 2000 was really sideways and then broke down in a big way in January. And now even rallying, it's not even regained that base. So I think that as we look back months from now, we could see the breakdown in the Russell 2000 as an illustration of the move away from risk on to risk off, where a lot of investors, I think, have been just programmed to buy every dip. And this might be one of those dips, which it's a short-term bounce before something worse,
Okay, well, you piqued my interest now, Dave. So I'd love to see some of the charts that you're looking at that might be making that difference between, are we going to resume this uptrend, or are we going to turn around and maybe give some of it back? So what's on your screen?
Yeah, so we're looking at the S&P 500 to start here, and you'd mentioned sort of this head and shoulders top, and I think you can think of this market in a number of different ways. Patterns a lot of times are super subjective, so I tend to focus on support and resistance levels, right? What levels does the market recognize as important, and how are we trading around those? Yeah. And if you kind of take a step back from this chart and look at what's happened, you have this consistent pattern of higher highs and higher lows really through the end of last year, where the S&P just continues to make new highs and pushing on to new all-time highs, peaking just around 4,800 in early January. From there, though, the big breakdown in this pink shaded area is right around 4,550. And that's called a level of polarity, which is a technical concept where you have an established level of resistance, which is where we peaked out in September of last year. That becomes support. So, a level of resistance, which was a ceiling, becomes a floor after you break out. When that broke finally here in January, that tells you things are different. That tells you instead of making higher lows, we're making lower lows. We've now retested that range from below, and once again, it's become resistance. So until the S&P can regain 4,550 and hold it, I would argue this is a market in a distribution phase, a clear distribution phase, by the fact that we've made a clear lower high here around 4,600, just below there earlier this month.
Yeah. So, I like the term polarity. I always call it like a resistance zone, since, I jokingly say this, but I think it's a true statement. If support and resistance was an exact science, we would all crush it all the time, but it's not, right? you got to think about that area that it's stalling, and in this case, where the S&P is around the 4,550 level. So so great. We've identified some pretty good resistance, and where are you thinking major support for the S&P is right now?
So you have to look down at the previous lows, right? It was around 4,300. I sort of think of it, you mentioned like a resistance zone. I think that's a great way to think of it. You want to think of these in terms of ranges. So I think of 42 to 4,300 is sort of like that range. 4,300 is the low from September and from October. It's arguably sort of the low that we established at the end of last month. 4,200 down here is a 38.2% retracement of this broader advance from over a year ago. And so that's sort of a number of support levels, sort of a confluence of support all around there. And another thing to mention, just in terms of how things have deteriorated, the momentum. So here at the bottom is the RSI. And if you look, every time the S&P has swung higher, the RSI has made lower highs. And that's a classic momentum divergence where the market's attempting to go higher, but there's less and less buying power behind each move to the upside. So if you're wondering what differentiates this move, why is this different than the other buyable dips? Look at these other buyable dips in much of 2021, where the RSI never really got below 40 and it would rally and become overbought on a move higher. That's totally changed. You're becoming oversold when the market sells off, and you're not getting above 60. And until that happens, this is still in a distribution phase.
And I see that we're and correct me if I'm wrong. That's your 200-day moving average that we're just kind of hugging around. So is that playing any part in your day-to-day decision making right now?
Yeah. So, if you look, it's pretty rare that the S&P is below its 200-day moving average really since February, March 2020. That's the last time we really kind of broke that key level. Other than that, it's been long and strong well above it. What's interesting, though, I would say it's not just for the S&P, it's the stocks that comprise the S&P 500. So if we look here, this is the S&P 500 again with the 50 and 200-day, and then this is the percent of S&P members that are above their 200-day moving average. It's currently right around 45%, which tells you less than half of the S&P members are currently above their 200-day. Last time we spoke was back here in early November. It was about 75-80% of the S&P above their 200-day. So in these couple months, as the S&P struggled to hold that sort of long-term barometer, over half of the S&P have now been unable to hold it as well. And that's really more characteristic of a bear market move than a bull market move for sure.
So this is maybe one of those indicators that you're looking at, that piece of the puzzle that's really suggesting that we should be selling rallies versus buying. Is that correct?
Absolutely. And I'll give you an example of why that. If we do a brief market history lesson, if we go back to 2009, so we're looking at daily data, but going back to the 2009 low, I've highlighted in purple those times when this indicator has gone below 50% for a meaningful amount of time, not just a brief dip below, but it's actually gone below and stayed there. And we're sort of right at that point where it feels like that's starting to happen. That's happened 5 times since the 2009 low. Those have basically been the 5 major corrective moves that we've seen in the market. Now, every one of those examples, once we initially broke below 50%, the S&P's made a new low before it's recovered. And so what that tells me is we're at heightened risk for, the low not being in yet, for us undercutting the low from January before all said and done.
It's interesting, Dave. We go and look through history. And by the way, I love history lessons, so this is awesome. You go look through history and, you'll have people that say, well, there's if the yield curve inverts and, certain bond markets or rates are rising, that's going to produce some headwinds. But in all actuality, we've been in a very bullish market for a long time, and rates do go up and down. So any setback that we've seen, any major setback, has been, relatively short-lived and always supported. You always end up buying the major dip if they come. And I know it's difficult to ask yourself, or anybody else for that matter, what could be the catalyst that would drive this market lower. But are there any internals that you're seeing that could really be one of those catalysts that could assist a bigger decline in the market that you're seeing?
Yeah, I mean, if you think about the broader environment, I should note the 2 charts you see in the background in my office. This one off my left shoulder here is U.S. interest rates back to 1915, and that is you can see the big move higher and the peak in 1980 and this big move lower. And remembering, I would say, even if you're a short-term investor, recognizing the environment that you're in, and at this point, we've been transitioning from a low rate environment to a rising rate environment. A rising rate environment is an environment that most of us have not seen for any extended, time frame for sure. And, I'm sure when we talked last, we talked about the prospect of higher rates. Now we're getting closer and closer to 25 basis point, 50 basis point rate hikes and a number of those through the course of the year. I think a lot of investors are underaware of what that will actually do at a portfolio, particularly growthy stuff that does not tend to perform well in that environment. So I think what we've seen with this market is what happens when the really growthy stuff, things like technology, consumer discretionary, communication services, when those are struggling to participate in a market, even if the cyclical stuff like energy is up 20+% in the first 6 weeks of the year, it's not enough to hold the major benchmarks up. And so I think, to your point earlier, when you think about what this market has actually looked like, you have energy up double digits year to date, you have financials up a decent amount, and then everything else is sort of flat to down, if not way down. The averages have sort of held in okay. And I think that's the environment you should be prepared for. If you're a stock picker, there are going to be opportunities out there. And it's all about focusing on the trends and following those trends. There are stocks breaking out to new highs in any environment. Even when everything feels like it's going down, you can find names that are going higher. And I think the investors that recognize this strength and energy and just follow those trends have been, compensated pretty well year to date for doing that.
You said it succinctly. It's a stock picker's market, and that's the market that you could argue, I look at interest rates and I'll say, I'll totally agree that, yeah, those are environments that, being somebody in the markets for over 2 decades, nearly 2.5 decades, I don't remember. But there are so many traders right now that do not remember. They don't remember even, anything below like losing 20% or anything else. So there's a lot of new blood out there, right?
Yeah, I was going to say, and for a lot of newer investors, they really have a limited window of market history that they've been participating in. If you and I think the 10-year yield is providing a perfect example of, if you don't look at a long enough time frame, you get trapped into a lot of times incorrect thinking. When I'm not a fan of this can't go much higher because it's gone up a lot, and the other painful example of this can't go much lower because it's gone down a lot. Prices go down for a reason. And just because they've gone down a bunch doesn't mean they can't go a lot further down. And the same thing with interest rates. If you look at the last year, it feels like, interest rates are at the upper right corner of the chart. How much further can they go? And you just need to back the chart up a little bit longer to see that they can go a lot higher, right? I mean, end of 2018, the 10 years above 3%. I mean, there's no technical reason why we couldn't get back to that level. And so I think recognizing the fact that just because things have had a run doesn't mean that needs to be over. And you saw that with the S&P in much of last year, where you could have made the argument that the S&P and the NASDAQ were overextended. The market doesn't care how you label it. It's going to continue to go. And so I think following the trends that are in place and recognizing that yields have gone up a lot, that there's no reason why they can't continue to go up there. And then just thinking about what your portfolio would do. Think about, let's say the 10-year goes to 2.25%, 2.5%, even higher. What are the stocks that I hold going to probably do in that environment? How are they going to, behave? Or, am I betting on the side of rates going up? And if not, you better be aware that that's a risk you're taking on.
Yeah. Well, what a great conversation. A lot of nuggets and gems for traders at home to really take home with you. And I'll tell you, Dave, if I'm at home and I'm watching you and I'm like, man, I wish I could get more of Dave Keller. How does that happen? How do I find out more about what you do?
No, thanks so much, Blake. It's always a pleasure to chat with you. 2 things. So on stockcharts.com, you can check out, all of our tools to help you make better decisions. And Stock Charts TV is where I host the Closing Bell show every day. And I look forward to people checking me out there. And then on YouTube, I have a channel called Market Misbehave, where I post charts like this to provoke your thinking as much as possible.
Awesome. Well, Dave, I appreciate truly the time that we get to spend with each other. And if you like what you've heard here today, make sure you give Dave a thumbs up on our YouTube channel. Subscribe to the YouTube channel so you don't miss any of the content that him and I have, and also other content that we have on the site as well. Dave, thank you so much for joining me today. And I look forward to our next conversation. Hopefully it's not 3 months from now.
Sounds good, Blake. Take care.
All right.
Talk to you soon.
All right. Talk to you soon. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.